Welcome back, everyone. Today, we are going to deconstruct an absolutely wild couple of weeks on Wall Street. Seriously, it's a tale of insane mood swings, totally conflicting signals, and really how the entire story that investors tell themselves can get flipped on its head in like the blink of an eye.
Okay, so check this out. On October 10th, the market has its worst day in months. It's plunging on fears of a trade war, headlines are screaming doom and gloom. Then, just 2 weeks later, it's not just recovering, it's hitting a brand new all-time high. The story went from disaster to party time, almost overnight.
So that's the big puzzle we're tackling today. How on earth does the main investment story, the narrative that everyone is trading on, do a complete 180 that fast? All right, let's dive into this.
So, our story really kicks off on October 10th. It was a day that started out pretty calm and, well, ended in total chaos. This was the moment the market got a serious wake-up call.
And the numbers from that day? They were just brutal. The S&P 500 was down almost 3%. But look at the NASDAQ. The one full of all the big tech stocks? It got hammered, down over 3.5%. That tells you right away that the pain was really focused on those high-flying tech companies that had been leading the market all year long.
So what was the trigger for all this panic? It wasn't some complicated inflation report or weak earnings. Nope, it was a single social media post threatening massive 100% tariffs on China. Just like that, the one fear that investors thought was kind of in the rearview mirror, a full-blown trade war, was suddenly front and center again.
And this quote from Solace Alternative Asset Management just nails the psychology of it. They said the market's complacency was broken. That comfortable, cozy feeling that trade tensions were a problem for yesterday? Yeah, that was completely shattered, and it unleashed a huge wave of selling. But then, and this is where it gets really interesting, just as quickly as that fear took over, it just evaporated. It was replaced by a totally new story. A story of an incredible, almost euphoric rally. This timeline just shows you the sheer speed of this thing. We go from multi-month lows on October 10th to setting all-time highs just 2 weeks later on the 24th. It wasn't a slow climb back. It was a violent V-shaped whiplash that I think caught a lot of people completely by surprise.
So, what was this new story that was so powerful? Well, analysts started calling it the Golden Rally Narrative. And it was, basically, the absolute dream scenario for investors. The idea was that the economy was going to be strong enough to avoid a recession, but just cool enough that the Federal Reserve would have to cut interest rates anyway. It's the best of both worlds.
And this belief, it wasn't just built on thin air. It was fueled by a whole string of good news. You had inflation data coming in a little softer than people thought, which seemed to give the Fed the green light to cut. You had big banks saying the Fed would stop shrinking its balance sheet. Hopes for a trade deal were back on, and then you get strong earnings from a company like Intel, and everyone thinks, okay, tech is fine.
And this quote from investor Mark Minervini, it just captures the mood perfectly. Rate cuts without a recession, don't fight the trend. That became the mantra. The fear of missing out, FOMO, was real. Everybody wanted in on this golden rally.
But, and you knew there was a but coming, right? Here's where our story takes another sharp turn. Right at the peak of all this excitement, just as the market was hitting those new highs, a totally different, much more cautious story started bubbling up right under the surface.
So, the first big crack was this growing gap between the market and the Federal Reserve itself. Investors were so sure about this golden rally that they were pricing in a 90% chance of another rate cut in December. But then the Fed chair himself, Jerome Powell, basically threw a bucket of cold water on the party, saying a cut was far from a sure thing.
And at the same time, it felt like we were seeing two completely different economies. On one side, you had companies like Google, where their cloud business was just soaring, proving that all these massive investments in AI were actually making money. But on the other side, you had what some people were calling the Chipotle economy. Their stock got crushed after they warned that their lower-income customers were starting to pull back on spending.
So this is the really crucial point. We didn't have one single market story anymore. We had two, and they were pulling in completely opposite directions. This is what's known as a K-shaped reality, where one part goes up and the other goes down.
And this chart just visualizes that split perfectly. Take November 3rd, for example, the main S&P 500 index. It actually finished the day up, but that was so deceptive. If you look under the hood, a staggering 80% of the individual stocks inside that index were actually down for the day. The entire market was being held up by a tiny group of winners.
And you know what? This divide existed even within big tech. Investors weren't just buying any tech company. They were getting super selective. On one day, October 30th, Google's stock went up because it was clear their AI spending was paying off. But Meta's stock got slammed, down over 11%, because investors were worried its huge AI spending looked a lot like its last big gamble on the metaverse, with no clear profit in sight.
So this brings us to the one single, overwhelmingly powerful theme that explains this whole divided market. It isn't just tech. It's a very, very specific part of tech, the AI revolution. And just to help you wrap your head around the sheer scale of this, just look at this number, $38 billion. That's the size of a single 7-year cloud computing deal between Amazon and OpenAI. This isn't just some abstract hype. It is a colossal arms race, and it is being fueled by absolutely massive amounts of real money.
You know, in this quote from Microsoft CEO Satya Nadella, it reveals such a fascinating piece of the puzzle. You'd think the biggest problem is getting enough computer chips, right? Well, he says, nope. The real bottleneck is getting enough electricity to actually run them all. It just shows you the enormous real-world infrastructure that has to be built to power this AI boom.
And here's the final twist in the investment story. To pay for this arms race, big tech is starting to move beyond just using its giant piles of cash. Now, companies are issuing huge amounts of long-term debt. We're talking 50-year bonds here to finance their AI dreams. This is a new, much more leveraged, and potentially riskier phase of the whole cycle.
Which leaves us with this one final critical question. The market right now is like a high-performance supercar, but it's a supercar being powered by a single, powerful AI engine, and it's leaving the rest of the economy in the dust. The real question is, how long can that supercar keep racing full speed ahead on a road that seems to be getting narrower and narrower by the second? That is the billion-dollar question that investors are wrestling with right now.